No immediate housing hope. Jay Powell spoke Wednesday at the Brookings Institute Hutchins Center on fiscal and monetary policy in Washington, D.C. Powell starts his address by stating that the U.S. inflation still remains far too high.
So today I'm going to offer a progress report on the FOMC's efforts to restore price stability to the U.S. economy for the benefit of the American people. And that report must begin by acknowledging the reality that inflation remains far too high. My colleagues and I are acutely aware that high inflation is imposing significant hardship, straining budgets, and shrinking what paychecks will buy. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation.
Okay, so now for the first time in over 2 years, the housing market is not good for either the buyers or the sellers. That means no record-breaking, overpriced housing sales and really no good deals for buyers, despite what we've seen in the reduction of home prices since the peak of earlier this year. And what I mean by that is that we've seen, at least locally here in Maryland, 5 to 7% price decreases from the peak, and then really across the country, up to 20% price reductions in the current home prices. But with the high mortgage interest rates, buyers are still just simply not able to afford a mortgage payment, and they're really just not jumping in at all. And for you renters, Jay Powell says that rental rates for new and existing renewing leases are still increasing.
So let's hear some of Powell's address so you can figure out your level of confidence regarding the outlook of the U.S. economy over the next 12 months or so.
Yeah, Melissa, and at least until we get the new job reports that should be coming out. And I think that's really going to tell the story because, we can look at all this historic data, this backward-looking data, but my concern for the U.S. economy is our job market, and that's going to dictate a lot moving forward.
After all, wage growth and decline is really what matters to consumers on what they're spending money on, whether it be necessities or for anything else for that matter.
Okay, guys, well, Powell's address at the Brookings Institute is really focusing on core PCE inflation. And one of the things I want you to keep in mind that this omits food and energy costs. Now, Powell does go on to say that food and energy has come down, but he does state that it can be quite volatile and that the inflation on these two components are still too high and matter a great deal for household budgets.
So let's have a listen to Powell speaking about the current rate of inflation.
So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections.
So for any of you real estate agents or mortgage lenders that said that Jay Powell or the Fed would pivot and that mortgage interest rates should be lower by the beginning of the year, you certainly must be seeing and hearing something that I'm not. I think, Melissa, it's clear to say here, listening to Jay Powell, that the Fed's commitment to lower this rate of inflation is of the highest priority.
Though the GDP growth seems to have slowed down or flattened this year since the tightening of monetary policy and the rising of interest rates, inflation seems to be stubbornly high.
Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into three component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex housing has fluctuated, but shown no clear trend.
So let's kind of dive into what Powell said and really break down the three components of the core CPE inflation. First, let's talk about core goods. So core goods, again, this is omitting anything to do with housing or utilities, but it really focuses on more of what consumers are spending and can range anywhere from automobiles to clothing. Now, Powell did say that this type of inflation has come down and that it's actually fallen 3 percentage points since the beginning of this year. And I can definitely, attest to that. Looking at automobile prices for myself, I've seen where, they've really come down over recent months.
And the second component is housing services, and those have really risen rapidly. Housing services inflation is said to have a large influence on the overall inflation because on average, consumers spend about 1/3 of their income on housing.
Housing services inflation measures the rise in the price of all rents and the rise of the rent equivalent cost of all owner-occupied housing. Housing services inflation really rose rapidly over the last 12 months and currently stands at 7.1%. And this is slower to decline because the rate of when rental leases turn over. Because most landlords have a 12-month lease, so the market rate of the new lease signings is more of a timely indicator as to whether this type of inflation is going down or continuing to rise over the next 12 months. And Melissa, when we look back over the last 12 months of the housing services inflation, new leases rose nearly 20% during the pandemic. But Powell has indicated that these rates have been falling sharply since about mid this year. But though despite the rates on new leases have come down since the pandemic, the real issue is that many of the landlords, when they're renewing the leases, are trying to rapidly increase the tenants' rates to try and get close to where the new market rates are. And, so this is a big timing issue as to whether, tenants are going to get some reprieve on their lease renewals.
But as the new rental rates are reduced and keep falling, the Fed expects the overall housing services inflation to begin falling sometime next year.
And that brings us to a really important part because as we know, these rental rates are affecting the investors and really whether they desire to continue buying houses. And without knowing where the rental rates will fall, I believe that this is one of the reasons that we've seen most real estate investors completely back out of the market, along with the wannabe homeowners. After all, real estate investors in the last several years have made up well over 30% of the total home buyers nationwide. And not to mention that these same investors, the 30% plus buyers over the last several years, they're one of the primary reasons why the house prices went through such great inflation.
And finally, Jay Powell talks about core services other than housing. These would be like healthcare, education, dining out, hotel services, pet care, the list goes on. He states this is the largest of the three categories, constituting more than half of the core PCE index. This is because wages make up the largest cost in delivering these services. The labor market holds the key to understanding the inflation in this category.
By the way, guys, we have the link below so you can watch the entire, press conference. Understanding the labor market in the last 2 years is really an important process of understanding the inflation and how we may see any type of deflation or reduction in the overall cost of living. And Jay Powell does indicate that over the last 2 years and the labor issues that we've had with so many people that were taking out of the labor force and what I believe, the higher cost of labor from employers just trying to get people back to work. I mean, we know that, there were headhunters looking to fill a lot of empty positions because the employers were struggling to get products, goods, and services delivered to the consumers in the rate that they were spending. And this created a whole problem, in my opinion, because, this type of overspending, though we do need wage growth, this rapid overspending of these employers really jacked up a lot of the core value or prices in the products, goods, and services that we're buying. So I agree that we need wage growth, and I know that we need something that is sustainable as far as a rate of inflation that we can all afford. It doesn't put us in debt and doesn't make us not have the ability to afford life's essentials. But where do we go from here? Are we now going to raise these rates to put pressure on companies and businesses to where they will have to reduce some of their staff? I believe that this is what we're seeing with a lot of the tech companies already, with massive layoffs. And unfortunately, I'm afraid that we're going to see it, even with the local businesses moving forward. Jay Powell said at the beginning of this year, when they started to increase the interest rates, that they were going to try and soft land this economy. I don't know if it's possible. Are we going to see now the crash landing that many expect? So, Melissa, Jay Powell here, I think mid-month is going to, as the FOMC meets to talk about interest rates, I think it's clear that he's indicated, and people have a good feeling that there's going to be about a 50 basis point hike in December, and that though they may start to slow down the rate increases, far from pivoting, far from letting off the throttle here, I think the Fed acknowledges we have a real runaway train here with inflation. And if you guys dive in and listen to Jay Powell's release here, you're going to see where inflation has really flattened some. He said that it has gone down, as we've indicated, but he also prefaced the warning that with low reports or declining inflation, in many cases, the preceding months indicate higher rates of inflation. So the work is far from over. So what I'm trying to say here, guys, is tying this to the housing market is I think that we still have a long road ahead of us. We've had 9 months of declining sales. We have seen home prices decline nationwide, but with the rise in mortgage interest rates and the overall cost of living, it's just not enough for most buyers to be able to purchase a home right now.
Yes, and understanding the downward pressure of home prices. How long will it take for sellers to come desperate enough to drop those home prices for the buyers to be able to afford them?
And we are seeing, sellers equally backing out of the market along with the buyers, because I think you're right, Melissa. If they're not desperate enough to drop the prices, they just may be forced to sit it out and wait. And I think that's the big question, guys, whether we'll see more inventory hit the market in the spring. As for now, we're all sitting on the sidelines. So we appreciate you watching our video. If you liked it, you can give it the thumbs up and let Melissa and I know that you did.
And you guys, we would like to hear your thoughts on the press conference. Post your comment below. We'd love to get your opinions.
Until next time, if you haven't subscribed to our channel, you can do so now. Please share us with your friends. Hit that alert bell, guys. You'll know every time we upload content just like this. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.